Right now we are focusing on the theme for the conference, which is the challenges and opportunities facing the asset management industry. So we'll start with a few questions to the panel, followed by Q&A. We'll open up the panel to Q&A from the floor. In the presentation, I think Gerard has mentioned one of the challenges that AMCs here face, which is raising capital from the rest and trying to take advantage of economies of scale. Alex has talked about the importance of the hinterland and perhaps how Singapore can take advantage of the private banking sector. So what are your thoughts on the opportunities that face the asset management industry today? Why don't we start with Madeline?
Thanks. I think, if you compare to, it's quite a fair comment to say that Singapore is actually quite a small country with a very small population size. But if you actually look at the neighboring countries around us, I think we're surrounded by many Southeast Asian ASEAN countries, which are actually a lot larger than us in terms of population base. In terms of growing middle income, if I'm not mistaken, I think by the year 2014, I think ASEAN will have roughly about 300 million people, in the middle income group, and that's approximately about 50% of the total population in ASEAN. Many of these are still yet to liberalize their pension scheme. Many of these are still yet to sort of truly liberalize their mutual fund industry. I think that's quite a fair amount of opportunities from that perspective. And if you compare to some of our non-Asian counterparts, I think this part of the world, you would say that comparatively it's still fairly undeveloped or emerging from that perspective. I think the other comparison that I would like to draw is, I think if you compare to some of our regional counterparts, our regime, the mutual fund regime, registration is slightly more open-minded compared to some other countries in the North Asian countries where regulations change every year. It becomes quite difficult for practitioners like ourselves to actually do business planning if regulations change every year. You have to change your entire business plan, what products you want to take, how many people you have to put on the ground, when regulations like this change, constantly. So I think from that perspective, I think we've actually gone through quite a, long development cycle. We can see ourselves as, being able to help some of the other Southeast Asian nations who are still emerging, who are still trying to grope through the dark, how they should liberalize their markets. So I think if you put into perspective Singapore as a center for the Southeast Asian business, the ASEAN business, I think there is quite a big, opportunity, from there. But we'll come to the challenges later, I guess.
Thanks. So Singapore does have a hinterland, and that's essentially ASEAN, the ASEAN region that we have not talked about earlier on. Hugh, any thoughts on this?
Well, I'll certainly pick up on regulation. I mean, that's one of, if we're looking at challenges, I'd say the regulators are pretty big challenges these days. Particularly in countries like Japan, where they're just totally ignorant of how to do business at all. I mean, it really is an appalling country. Singapore's pretty good, thank God, which is why most of us have big operations here or indeed in Hong Kong. So regulation is the new challenge, if you like, for asset management. And as a business, it's become a lot more capital intensive. I mean, in the early days, it was just a desk and a phone and off you go. No longer, you've got a huge infrastructure involved in asset managers of any size, so that's certainly a big challenge for the industry. And then the perennial challenge, I think, is keeping our staff, incentivizing them and creating a sustainable business, because I think most of the asset managers, with one or two exceptions, Fidelity being one, they come and go, break up, disappear. Not many last beyond a generation, so it's a pretty hopeless industry in many ways. Lots of people get rich very quickly, and the clients typically are a lot poorer as a result. Sorry, I don't have a lot of good to say about our industry. Maybe I should, but it's still a great industry to be in. Maybe I should leave it there.
Thank Thank you, Hugh. Thank God we don't have any Japanese regulators in the audience. So, any thoughts from Gerard, Alex, or Mark on the opportunities in the asset management space?
Well, I think actually there has been, and I think there is a significant opportunity on the alternative side for Asia, meaning hedge funds and private equity funds, broadly defined. I think from, of course, some of the Western institutional investors have been burned in the past in 2008, 1998, and to some extent over these last few months owning, the beta in the markets. And I think what we're hearing from some of our investors ex-Asia and our investors here is they want more of a risk-adjusted approach and an opportunity to generate alpha. And if you look at, for example, long-short equity hedge funds, we do view the markets, of course, as more inefficient out here than, say, the U.S. or developed markets. And there are inefficiencies to exploit for, we think, good fundamental managers. And now there are restraints in terms of shorting broadly defined around the region, but I think that's developing as well. And there are managers out there that we've seen even over the last kind of year or so that have very differentiated returns by very good stock picking. And I think that what we've seen is, in terms of, there have been very few of those, and I think as there's more homegrown talent that develops, we look broadly defined at fundamental investors, and as that develops, I think there will be more managers to select from, and I think that could be a long-term opportunity set. And I really do see long-short investing in the region as something that could have the success, for example, that long-short investing had in the U.S. in the 80s and the 90s, up until there was significant supply of managers. And now you have a lot of people doing the same things in crowded trades, but there's not that many managers doing that in Asia. And so I do think that will be a very good opportunity for the long term.
Okay, so you're basically saying that there seems to be some avenues for growth in the equity long-short space, especially in regards to the local talents. Anything to add, Gerard?
Yeah, I still want to look at the negative side of things. This side is a negative camp, okay? Optimistic. The challenges, unfortunately, despite all the good things I said earlier, is that there is no decoupling. All right? Every time something bad happens in the US or Europe, there's more money flowing out of the market than there is money flowing out of those markets which are guilty of the sins. So it's always a problem. So not only in recent months have we seen the outflow of equities, despite all the good virtues of secular growth and higher earnings. In more recent weeks, we have seen the dollar C moving from 120 to 130. It is not reflecting on fundamentals. It makes it very difficult for you to manage money like that. When you're trying to grow your business, when you're trying to grow your industry, you cannot take this sort of volatility, because attendant to that is obviously transaction cost, morale, compliance, and it's a whole series of things. So unfortunately, that's the way the world is. No amount of education, regulation can solve this thing. We just have to bide our time, and over time, things like that will change. How that will change would be, we need to have more domestic investors. And the time has not arrived yet until we get foundation, endowment, pension, sovereign wealth funds, and so on and so forth that are indigenous to Asia, willing to invest in Asia. We will still be victims of this outflow. So, in fact, every time the beta is higher than 1, whenever the market falls. So that's a big problem. The other big problem, again, this is really trying to take a good look at ourselves, Asians. I think there's a lot of mistaking luck for a genius. Yes, you know, we are hardworking, we have high savings rates, we are well trained, we are numerate, and so on and so forth. Not guilty of a lot of sins that are being committed by the Europeans, for example. But yet at the same time, we are not learning the rules of the game. The rules of the game, they have been written in the West for a long time, especially in the areas of asset management, how you should have a rigorous and robust investment process. Mark, I think, articulated it very well. Asian asset management companies are usually less transparent, okay, and they get very annoyed when consultants and gatekeepers ask more questions because, you know, they feel it's not necessary. If at the end of the day I can prove to you that I can make money, why do you want to ask so many questions? But those are the rules of the game. You have to play by the rules of the game if you really want to see the AUM. And the other third challenge that all of us grapple with when you rise through the organization is the area of pay. It used to be that a fund manager in Singapore in the mid-80s probably cost only about 55% of what you need to pay somebody in London. Today, the pay of the guy in Singapore is already at the same level as the guy in the UK. Mainly because, of course, the pound has weakened, but more because, you know, the demand for talent, especially from the private banking side, has sucked away a lot of good talent that we have nurtured in the asset management industry. So we have to compete with them. Yeah? And the private banks have a cost-to-income ratio of higher than 100. We are trying to keep ours below 50. So it's a real challenge. It's a bit like English Premier League, you know. They want to be paid first before they score the first goal. You ask them why they haven't scored a goal, they say it takes about 2 years, you know, before they can score the first goal. So those are my challenges.
Okay, so unlike Hugh, who has challenges with problems with regulation, the challenges are essentially retention of people and avoiding being whipsawed by the global financial markets. Any thoughts, Alex?
Perhaps to bring some balance between the pessimist and the optimist, but also at the risk of possibly sounding idealistic, actually, is that is bringing Hugh's thoughts on if our clients are making money, and Mark's earlier thoughts about managers' incentives or having quite a bit of their wealth tied to what they're marketing. I'm just wondering, how would our industry look differently if from private bankers to people who are in sales and fund management to fund managers are paid only if our clients get rich? And that will obviously have that ties in once again with my point I made earlier about the importance of advice over products. The many good products out there generally, but what is clearly short is on advice. I feel at times that our distributors would like to hear from fund managers which of our funds we would sell, and not sell meaning the clients should redeem, rather than us necessarily promote in terms of the sales process to the distributors. So, but I think the whole chain as such, if it's driven by what it takes to make our clients rich over a certain time frame, I'm wondering if that incentive, if people is guided by that thought, if it might result in a difference in emphasis on time being spent on asset allocation, and in terms of how the sales process might also be handled.
Right, so there are some issues regarding how incentives are aligned in the asset management industry as well. So we have the pessimistic camp here and the optimistic camp. Would the optimistic camp like to say something about the issues that you brought up, the challenges that you brought up by Hugh and Gerard?
Well, I don't think I'm necessarily just optimistic or idealistic. I mean, I think, you know, the challenges that's been brought up by both Hugh and Gerard are very well-founded. I think, you know, irregardless of the market, asset retention is probably more tough than raising assets in a way. I mean, you can raise the assets, but the question is how long you can actually retain the assets, irregardless of the markets. When markets are good, asset retention is also tough, but it's just that, you know, when markets are good, you are sort of like helped with the headwind, yeah, you're not going against it. You know, I think the point on talent and the escalating cost is actually very crucial as well. The Asian asset management sort of in the industry has grown at a very rapid pace in the last, you know, few years, and therefore, along with it comes, you know, the talent there. You know, you don't necessarily have a lot of people who are, you know, very good in what they are doing. You know, some of them have also been born during bull markets. A lot of them have not seen bad markets. I think in the 2008 crisis, a lot of them were just seeing the bad markets for the first time. You know, and definitely cost has grown up. Our business is a business of, you know, based on assets. So every single day the markets move, you know, it does affect our revenue. So I think trying to balance between the revenue and the cost is going to be quite crucial. How do you balance between being, you know, being able to actually have, you know, minimum engine to actually promote growth, but at the same time not escalate your costs such that your costs cannot cover your revenue. I think that's actually quite a fine balance. So I think trying to find a balance between growth and trying to keep your costs at a good level, getting good people, I think is quite important. I think whether it is actually in the sales, you know, administration part or is in portfolio management, talent is not homogeneous. It's not easy to actually just get good talent all the time. And I think that is actually quite a crucial factor to the business.
And the problem is you need to pay to get good talent very often. Like Gerard says, something you pay in advance. Any other thoughts on our theme, challenges versus opportunities for asset management?
I would say, just to echo your presentation about being closer to the investments, is that I have seen, or we have seen over the past few years, investors, Western investors, where, for example, they used to invest, say, in an investment firm based in New York, covering Asia from New York, that there has been a transition, I think, as the talent has developed to investing in firms that are based in Asia, that are closer to the investments. And I think also what has helped is you've seen, even over the past 6 months, you know, some of these large hedge funds based out of the U.S. invest in things like Sino Forest and Long Top, you know, stocks that were perceived as frauds. And you know, some of the Asian-based managers who had teams on the ground here, you know, may have invested, may not, but I think the Western investor recognizes the tremendous benefit that you have of homegrown talent who knows the culture, who knows the language, that's close to the companies. And I see that continuing to trend positively as the talent develops.
Right. Over time, we've seen people like Fortress, for instance, come down and set up shop here, and their specific goal is to sort of trade Asia from Asia. Any other thoughts, Hugh?
Yeah, I might add some optimistic thoughts, and just follow up one issue. I must say with Gerard, I love volatility in markets. I mean, that gives great opportunities. I don't think one should be frightened of it, and it's a welcome reminder that you can lose a lot of money in markets, which I think people need. So I'm positive about volatility. I don't find it a negative. I've lost track of the crises I've been through in markets over the years. But on the positive side, I mean, a huge amount of money has come to this part of the world to be managed. In the old days, all the money really for Asia was largely, I guess, largely in the UK. And the US was quite slow investing in Asia. Now most global firms have moved out here and are genuinely managing assets from this part of the world. So that's been a major shift. So that's good news, I think.
That's great. In relation to Gerard's point, given that you're from Aberdeen, do you, for instance, follow the model where you raise capital on the rest and then invest it in Asia?
Yes, crudely we run 100 billion US investing in Asia, of which I guess 25% comes from Asia, but a big chunk of that actually comes from Australia. It's quite a developed market, so if you look outside Australia, it's still there.
It's a superannuation fund.
Yes, it's still a small, a relatively small market, so the big money is coming from North America, sovereign, well, for us anyhow, sovereign wealth funds. And our UK base, I think, is probably only about 20% of our assets, so it's quite well diversified, but there's been, a lot has been coming from North America.
That's interesting to know. One last question for the panel is, I mean, we have skirted around this issue, but we've looked at the difference between Hong Kong and Singapore. And let's talk about how Hong Kong sort of leverages on the Chinese hinterland. And we also mentioned briefly about how Singapore could try to take advantage more on the ASEAN countries and on the private banking sector. So what are your thoughts on how these two industries in these two financial hubs have evolved over time? How are they different? How are they similar?
Okay, I think the competition between Hong Kong and Singapore, in my opinion, at last is being settled. It's being settled in the evolutionary way and going to be quite harmonious. Good news, there's not going to be any war fought. The reason for that is, if we can use Europe as the analogy, where the center of gravity is London. It doesn't really matter whether the IPO is from a German company or from any part of continental Europe. Most of the IPO, capital raising will be done in London. Then you have this country called Switzerland. It's a small country, has only about, I think either 15 million people, about 15 million people. It's about 3 times the size of Singapore. It has Zurich, it has Geneva. It's a wealth management center. And for years, it has thrived as a wealth management center. Now you bring that model to Asia, and this is exactly what's happening. Hong Kong is thriving as a capital raising center, so whether it's equity origination or debt origination, mergers and acquisition, all the sort of sexy stuff, very interesting stuff. It's all happening in Hong Kong. But Singapore is a wealth management center. And earlier in my talk, I illustrated to you, PwC has done a study. They came to the conclusion that by 2013, Singapore would be the biggest wealth management center. So that's good news, because by definition, Hong Kong would not be the center for the mainland Chinese to park their money. Private banking, offshore banking is about contingency. The fact that there's a lot of private banking activity happening in Hong Kong now is mainly because of convenience. It's incidental to the many other things that the rich people are doing. But over time, as they plan for their contingency, as they plan for their future, they want to move away from Hong Kong. So Singapore is a great destination. So I think Singapore's place in the sun is a wealth management center, and everything else that we do, I think, will revolve around our center of excellence in wealth management. And Hong Kong is really about investment banking, it's about capital raising, it's about M&A. So I think that is where it will settle.
I'm sure the private banking guys in Singapore are hoping that the F1 contract will be renewed. Any thoughts on Hong Kong versus Singapore for Mark, Madeline, or Alex?
Well, you mentioned Fortress earlier, and one of Fortress's co-global macro managers who moved to Singapore to run their operation. And so from a hedge fund perspective, there does seem to be the trend in terms of global macro developing out of Singapore versus Hong Kong. having to do with in terms of commodities and currencies being traded in Singapore versus Hong Kong, where I think that you see still more, at least of the long-short equity coming out of Hong Kong. But what we've seen in terms of long-only equity, that actually, that as we look across our universe of firms that we recommend for long-only equity, more of the firms are actually based out of Singapore.
So I should say something about Hong Kong. In the first instance, I think Gerard is half right about the seeking of refuge beyond Hong Kong, because I think in today's world, you can make a distinction between where your assets are domiciled and where you're served. And still a lot of the Hong Kong, in that sense, benefits from its close proximity to a lot of the mainland wealth that are typically also listed with companies listed, for example, in Hong Kong. But that being said, I do not want to downplay for a minute the importance and the growth and role that the Singapore wealth management market has. And a lot of the gatekeepers for our distributors sit in Singapore as well, so indeed there's a very critical role to be played here. What we have noticed as an evolution as China emerged in the region is firstly investing into China from outside in, meaning through its shares, and from Hong Kong or from Singapore, from outside centers. But increasingly, we are noticing as well with our client base an interest to invest through Q3 facilities domestically into the A-share markets. And they seem to have caught on as well into some of the slides that Melvyn has shown about proximity to the markets. And they are as well looking into domestic firms as advisors or managers for those local assets. And so what we're seeing as well, and that's, if you like, a challenge for Hong Kong, is the rise of the domestic asset manager, who, incidentally, has a view that they are more rightly placed to be managing China or Greater China assets.
Yeah, Hong Kong is close, but Shanghai is even closer, right? Any other thoughts from, thanks for the very balanced viewpoints. Any other thoughts from Madeline or Hugh?
I mean, I think both will have its own strength and both have its own hinterland. So rather than saying that it's competitive, it's probably better to focus on collaborative, you know. And I mean, like for a global manager like Fidelity, I mean, it's important that we're in both locations so that we cover all the markets, both from a business perspective as well as an investment perspective. So today we cover all our Southeast Asian, ASEAN markets, you know, with analysts from Singapore, and you know, Hong Kong will be there for Hong Kong, for China, you know. So I think it's a more collaborative play than, you know, a competitive play.
Thoughts, Hugh?
Just really to agree with that, although the regulators aren't quite as collaborative between Hong Kong and Singapore as maybe our organisations are, and for if you like, our headquarters are here in Singapore with a subsidiary office in Hong Kong effectively, but it can work equally well the other way around, and there's balance. And we do collaborate, but the products are not quite as easy to move across borders between the two for some very strange reason.
Is it regulation related?
Yes.
Must be.
One doesn't recognise the other, basically.
Okay, with that, we have really finish up this panel. We'd like to open up the discussion to the floor. Do you guys have any questions? Maybe we have time for about 1, 2, or 3 questions before we go for lunch. Any questions for our panelists? Yes.
I just read a recent report from Financial Times that saying that mutual funds in UK face a similar problem with what the panelists discussed in retaining capital and attracting new assets under management. And one solution they propose is to launch active managed exchange traded funds. I just wonder, would that be a viable solution for AMCs like yours to use the expertise to launch an exchange traded fund so the investor can also have instant access as well as participation in all your expertise? Is that viable or is that going to be too exotic? Thank you.
I think UBS is very bad experience with exchange traded funds. But any thoughts?
It's not our cup of tea. I'm not a fan of ETFs at all, but, so no for us, but I'm sure someone inventive will do it. But
my thoughts on ETF is that the easy part is over, the first phase of jumping on the bandwagon into an ETF, because it's morphed into synthetic ETF, and that is where the problem is. If you look at the number of listed ETFs and look at the daily trading volume, some of them take thousands of days in order to get out of the position because it's hardly ever traded. And then now with the unraveling of what we have found at UBS, you know that it's actually not as passive, not as safe, not as Delta 1 as they will call it, meaning fully hedged as it is. Somebody in the food chain can figure around with it, and if you're buying a synthetic ETF, you're basically taking on the credit risk of the intermediary, the issuer. So it is not as clean, as neat as it should be. I personally feel that the regulators should be spending more time trying to examine the synthetic ETF rather than try to come after those of us who are managing mutual funds here. Yeah.
Good to move your attention away to someone else. Any other questions?
Before I ask my question, I just want to read a few remarks made by Bob Monks in his speech to the ICGN conference very recently. He said, globalization has exacerbated the problems of effectively holding corporations to account. In the absence of global institutions, laws and regulations, the only effective enforcer of corporate governance standards is ownership. Shareholders' involvement is stigmatized as being short-term and therefore the enemy of long-term value creation by management. The inability and unwillingness of institutional investors to effectively monitor and require accountability of management is one of the principal causes of the continuing financial crisis. Now, my questions to the panel are, to what extent is corporate governance considered an opportunity in the investment process? First question. Second question, what are the challenges of exercising ownership responsibility on behalf of owners in stewardship? Thank you.
Thanks for the very comprehensive question. Anybody would like to respond to this?
my pet subject, corporate governance. It's absolutely critical to our job before you invest, and I'm afraid most fund managers don't pay attention to it. They say they do, but they don't, which is a weakness of our industry. And that's related to these turnover figures. They never hold the stock long enough to worry about the company itself. They're just thinking, I'm buying it at 1, I'll sell it when it gets at 2 and as quickly as possible, which is an industry problem. I mean, there's some very good people within the industry, I like to think, working at it. And maybe you can ask the next chairman of one of the companies we invest in, wasn't very happy with us, which is why he's ex. Now, when I think it is up to institutions and investors to focus on corporate governance before they invest. As I say, most people don't. They should, because that's what will make you money over time, a properly run company. So a lot that we're responsible for. I mean, a lot regulators are responsible for. So Hong Kong turned down Manchester United, Singapore took it, which is interesting. There's been inherent conflicts here as well, listed companies seeking to grow returns for shareholders and at the same time to maintain industry standards. The two don't mix, so I think you've raised some big issues. Absolutely vital corporate governance, and it gets forgotten in the good times and then focused on again after people have lost money, but they quickly forget, which is the great shame.
Yes, memories are always short in this industry. Time for one or two more questions.
I'll just speak up. Hopefully you can all hear me. Yes, my question is, so we briefly touched on the subject of regulation, obviously, here in Asia. But in comparison, the regulation that's sweeping through Europe and the US for asset managers and hedge funds is actually a little bit more crippling right now. And it's been suggested that in the medium term, we're going to be seeing a lot of asset managers, those which aren't already here, moving across. So from the fund distribution perspective, what's going to be the impact of this increased competition? And what are you doing to protect your market share going forward?
Mark, do you want to respond to this?
Well, I would say that in terms of attracting Western institutions, that asset managers based here will still have to follow, for example, the regulatory reforms in the U.S. In terms of funds registering, SEC registration, to attract that institutional capital and to get that comfort. And so I can't speak to the dynamic in terms of from the fund management side, but I can speak from a Western institutional advisor side, is that most institutional firms will abide by regulations globally.
And I say the big issue that we've come across has been, I'm sure it's not the only issue and it's not my area of expertise, has been the Basel capital requirements in Europe suddenly applying to fund managers, which doesn't make sense to me if you're not holding client assets and they're all held in trust. Why should that apply? And there's been quite a long argument over that, which does seriously affect business and make you think, gosh, actually as a business, you want to be elsewhere in the world. But I think as far as otherwise, the regulations, from what I see, are all pretty sensible and pretty global for our industry. And I think people will be driven out of areas, I'm afraid, for rather greedy reasons. They don't like paying the tax bill. So you will see people move for those reasons, and have seen people move for those reasons. But I'm not sure that in itself is going to add to competition here. I mean, most international managers are in this part of the world anyhow, somewhere. So I'm not sure you'll see a huge shift, other than the normal shifts that occur within our industry.
Thanks. Last question.
Good afternoon, dear panelists. My name is Kobe. I'm from a Swiss management consulting company. Most of our clients are private banks, sorry to say that. And I'm particularly interested about the one point raised by Martin when he's talking about the operational structure. One point is that the third-party administration is definitely a must after Madoff scandal, and because that's part of our business as well. The question is that currently we are facing the challenge of the really opening the market because fund industry really interests them, so to say that, and the closed industry for us. I'd like to know what is really your pain and where do you really need a third-party consultant to serve you? Yeah, thank you.
Well, I was speaking to third-party administration in terms of independent valuation of securities. Does that pertain to your question? In the sense of post-Madoff, who of course was valuing internally and didn't have an outside party valuing the securities, that was one of the operational red flags. And so there were many institutional firms that had an internal valuation, say onshore, that post-Madoff, in reaction to that, institutional investors demanded that there be third-party verification. Is that related to your question?
I think silence is a yes.
Thank you. Yeah.
Thank you. So with that, we have come to the end of the conference. I'd like to thank the speakers and the panelists for a very interesting discussion.